Hello, my name is Bryan Brewer. I'm the founder of Funding Quest here in Seattle, Washington. And I'm an expert in helping startup companies raise funding. That's what I've been doing for more than 15 years. And I'm here as part of the Founders Live program to talk today about building a fundable company. So what does that mean? A fundable company is basically that you have built up enough of the right stuff in your company in terms of the team and the product and the business model and the deal and so forth. And we'll go into this in a little more detail later. That you've got enough of the right stuff so that investors will take you seriously. In other words, you've got the right stuff and you are fundable. Whether you get funded or not is a completely different process. So before we go on, let's just take a quick look at this slide about the startup funding process. So you notice it starts with having an investor-ready startup. That's what we're going to talk about today, is how do you get your startup fundable, in other words, investor-ready. But then there are these additional steps in the process where you structure a term sheet, where you set the terms of the deal for investors. Then you need to connect with investors, give your pitch, and close the deal. We'll talk about some of those other steps later. But I just want to emphasize right now, you'll see that this big green arrow on top there shows that raising investor funding is a sales process. So you'll do much better if you treat it as a sales process and bring all those sorts of sales process tools and methodologies to bear on your process of raising funding. And we'll talk about that in a later program. But let's get back to building a fundable company. What do you have to have? Well, I break it down into 5 main areas, and I call these the 5 factors of fundability. They are first one is startup viability, which basically means do you have a product that people want to buy? Is your company going to be viable? The second one is your business model. That has to do with how do you make money and how people pay you. The third one is your market strategy. Well, once you've got your product and your business model set and you go out there in the market, what kind of tools and advantages or leverage do you have that will bode well for your success in the marketplace? And then the fourth factor is management. That's one of the most important things that investors look at. And then the fifth one is the deal. And that's, how does your deal stack up against other deals that investors are considering at the same time? So these 5 factors are critical. No one's going to have a perfect startup. I'm not suggesting that you will fail if you don't have everything perfect. No, you have to have enough in each of these 5 areas so that investors will look at your company and say, okay, they don't have everything put together, but there's a chance here that they may succeed. So let's go on and let's have some more discussions. Let's hear your pitch and let's get to know you and see if you're worth investing in. So let's go back to these 5 factors and drill down in a little more detail. The first factor is startup viability. And again, this is a way to measure, how well are you able to describe your business. I was just in a meeting earlier today with an investor who was saying that giving a succinct pitch is a key indicator to him about whether or not you know what you're doing. So giving a concise business description that other people will resonate with is really important. Second is your problem-solution match, or what I would call market fit is another term for this, are you offering something to customers who really have a need for it, who will, in all likelihood, some of them will actually buy your product? That's the big question there. How do you find that out? Well, the third one is market validation. What have you done so far to get some kind of validation? Have you got focus groups? Have you got surveys? Have you got feedback from people saying that, yes, they would buy your product? And of course, the fourth factor here is business stage. If you are far enough along where you actually have revenue, that's impressive because you're actually not just speculating that customers will buy your product, you're demonstrating that they will. Let's go on to the second factor of fundability, what you need to do if you're going to build a fundable company. You've got to have a solid business model. Now, here are some factors some elements that investors will look at in terms of your business model. They want to know the market size. Are you addressing a big enough market that's attractive to them? That could be either in terms of the dollars that are spent or the number of customers that are available for you to reach. Secondly is the market growth rate. Investors love markets that are growing fast because there's room for a lot of entrants, and and the competition is less severe. Third one is gross margin percentage. Do you have enough gross margin in there, and so that you can put adequate money into marketing your product and still have a profit? And then finally, recurring revenue. Now, you may or may not have a recurring revenue model in your startup, but if you do, you get extra points for that because investors love recurring revenue. Basically, if you can sign a customer up and they're going to keep paying you month after month, that's a big plus. All right, let's move on. The next factor of fundability is market strategy. And here the investors want to look at market efficiency. This has to do with the ratio between how much do you have to pay to get a customer and what's their value over a long period of time. And if they have high value with the low cost of customer acquisition, that's going to be favorable for you, and investors are going to like that. Second is partnerships. Do you have any partnerships in terms of distribution or development or other aspects of your business where you are leveraging other people's either money or resources or time in order to help bolster your startup and move it along faster? The next element here is partnerships. Do you have any partnerships in place with other companies who are going to provide development resources or distribution channels or marketing assistance to help you get your product developed and out into the marketplace? Investors like to see partnerships because that means they don't have to put the money into you developing all those resources yourself. Next is competitive advantages. What kind of advantages do you have? Investors want to invest in a company where there's an unfair advantage. And if you've got one of those or several, that's a big plus. And you should strive to get some competitive advantages that'll work for your startup in the marketplace. And finally, in this section is intellectual property. Do you have patents or trademarks or trade secrets perhaps, or intellectual property of that sort that gives you, again, a competitive advantage or an increased value for your company? The fourth factor of fundability is management. And again, this is very important. First thing they're going to look at here is the level of experience of the CEO or the founder. And if you don't have any experience, you can make up for that by having a strong team and strong advisors. But it's much better if you've done this before, if you've had some experience in a startup or even had a success in a startup. That counts for a lot. The second part of the management picture is your team. It's very rare for investors to invest in a startup of one, where it's just the CEO. And so as you build your company and get it more fundable, you want to pull in team members that are really going to bolster your credibility in terms of who they are, what they've done, and how they will be able to help your startup be successful. And then finally is board of advisors. Many startups neglect this one, and it's a really easy one to do to really get some good help. Find a handful of advisors, 3 or 4 or 5 folks who've been there, done that, and are willing to help you by giving you advice and also giving you contacts to help move your startup along faster. And then finally, the fifth factor is the deal. Now, there's 2 different aspects of the deal, and because there's 2 different kinds of ways that investors get paid back. The first one is a high-growth company where investors will get their money back when the company is sold. In other words, they'll put the money in the company and they want you to spend it, reinvest it, grow the company, make it attractive so that you'll find a buyer who will then buy it at a high price, and then they can share in the return on that acquisition. Some of the factors in a high-growth company deal would be what does your revenue or your net profit look like in several years? What's the percentage of ownership that investors get? Are you going to be able to achieve your milestones? and what's their potential for getting a return on their investment and how long. Now, second part of a deal, if you have a cash flow business where, in other words, you're going to take the investor's money, start building your company, and start making profits and pay a portion of those profits to investors over time. That's a cash flow business. And it's a different model. You have to look at the deal differently. In this case, they're more interested in the rate of return, how soon are they going to get the returns, how long are you going to keep paying returns on their investment, are they able to sell their ownership to someone else if they want to get out of the deal? And finally, is there any security for the capital? Do you have any hard assets such as equipment or real estate that can be used to secure part of their investment? That gives them a little more security and possible recouping some money in case you go out of business. So those are the key factors that you need to pay attention to when you're quote building a fundable company. So I know I went over that kind of fast, but there is a way that you can look at this in more detail, and that's this tool that I developed. It's called the Minimum Fundable Company Test. It's online at mfctest.com, and it's free. You just have to sign up with your email or other kind of login. And there are 20 questions, and most of them are metric-based, or at least fact-based about what do you have in your company or not. And if you answer those questions and get your score, it will give you a pretty good idea of whether or not you're ready to go raise investor funding or not. Anyway, that's what I think you have to pay attention to when you're building a fundable company. And so let's segue now and see if there are any questions. Thank you.